Would you all please join me in welcoming Chris Dibble.
I was just saying that photo of me might have been taken just a couple of years ago. I might need to update that one. But look, everyone, thanks obviously for coming here this evening. It's a fantastic spot. This is my first time here, unlike Tony, who's been here a couple of times. I'm really quite keen to come out here again, but I'll probably just try and be maybe outside rather than inside. So look, yeah, I'm here to give you a bit of an update on what's happening from a commercial, industrial and retail sector perspective. I've sort of not too much on the economic side. Obviously that's been handled brilliantly. What I am going to do is have a look predominantly at Auckland and then of course the wonderful North Shore. Similar sort of thing. If you've got any questions, shout out, that's all fine, or we can have a chat maybe over a few beers or something else afterwards. So look, as a quick recap, yeah, gosh, it was going beautifully, wasn't it? Businesses it was all going great. Their capacity was a little bit of an issue, as Tony mentioned, but ultimately things were pretty good. From a property perspective, things were pretty good. If you could find space to lease, things were pretty good. The business, from a business side of things, even though, those rents, those pesky rents kept on going up, the business, I guess, was making enough money to sort of assist it. No one's ever happy, but, some pretty good underlying fundamentals and dynamics in the market. Investment activity was pretty good because we'd had these low interest rate environment, that was really enticing those investors. But of course, yeah, it did start getting a little bit unstuck. We, funnily enough, obviously as an international business, get these signals from all around the world. We were it was early February for us, where we had one of our colleagues had been recently up in Singapore, came back and said, hey guys, we really need to get some hand sanitizer. And we all thought he was a little bit strange at the time, but probably should have invested in some companies for hand sanitizer. But look how much our world changed, and really it was sort of that early March period that really did provide us a few interesting nights of sleep. This is my one chart on the economy. This actually goes back a few weeks now, but I think one of the things that it really sort of highlights is that it's just really hard to understand what is going to happen. So this was all the different banks and the Reserve Bank in there trying to have a bit of a go at what GDP is going to look like after this bounce back, which everyone was sort of expecting. Is it going to be V, U, W, all those sorts of different things, and how long it was going to take. And so depending on the economic forecasts that you were reading, or the people around your table you were getting information from, you would have had a relatively different environment. So as you look at BNZ there, I don't know what happened, Tony, after you left, they all got pessimistic. But look, between BNZ and Westpac, it's almost a 24-month difference in regards to where they were thinking the economy would bounce back to. And of course, the other thing that we keep on hearing, and Tony mentions as well, gosh, it's a bit more better. It's just a bit better than every time. Every time we get a new economic update, it's just that little bit better every time, more positive, less unemployment, so on and so forth. So, look, it is an interesting time, and I guess what this sort of does for us in our world and in the commercial, industrial, retail space is go, okay, so what are people going to do with this kind of information? Obviously, there's a lot of volatility, there's a lot of uncertainty. So people are always going to start to go back to those fundamentals and try and figure out those fundamentals over a long period of time. So what I'm going to sort of focus on now, I've got around about 13 or so slides. I'll probably take around about 20 minutes to go through. Just look at the demand, the supply, what's happening from rents, and then the investment market, and then we'll wrap it up from there. So hopefully you can sort of see that at the back. I know that beautiful sun is coming through at the moment. It looks very lovely. You guys picked the best spot down there, I reckon. But what you can see here is a variation of vacancy rates, and we sort of use this to signal where demand is over a long period of time. Colliers has been around for a long period of time, so we're lucky we've been capturing this information really since the mid-1990s. So what you can see really after the GFC was a massive amount of growth, and we sort of know this, businesses were going really well, but they just couldn't really find enough space. We decided we didn't want to build anymore, and so it really took us from about 2010 to 2011 before we would start building. We focused a lot of our building activity into the residential sector, and of course, the commercial sector has sort of been playing catch up for a long period of time. So a couple of interesting things that you can see there, I guess the dark blue in the retail sector, look, that has actually started to shift upwards ever so slightly, but since 2015. So there was obviously a lot of changes, as many people will know, online retail spending and the like. It's actually shifted the vacancy rate profile and that demand profile for retail space overall in Auckland, for a long period of time, almost 5 years now. And with what's happening with COVID and how businesses, if they haven't been able to survive, that vacancy rate is starting to increase. What we can see for the light blue there, metropolitan office, and the light grey, which is just it's actually your CBD office market there. You can see basically since about 2009, 2010, the markets became very aligned. And again, this was just really that search for space across the whole Auckland market as businesses geared up for what they could see was, a little bit better expectations in their own activity. And it's really been driven very, very strongly. But what we are seeing really in this last little bit is this increase in vacant space as businesses come to grips with different things like working from home. So just a quick question, who here works from home on occasion if they have that opportunity? Yep, there's a few people here. How many times a week, maybe once or twice? Is that sort of, yep, 5 days, brilliant. Look, Monday and Friday, are those the days that you like to, those are the days I worked a lot, it's funny, isn't it? Almost every survey we do, Colliers International's done it across 30 different countries, similar sort of results. One other interesting thing potentially, are you productive at home? We often get, I'm very productive at home. We also ask the other question, the follow-up, do you think your colleague is productive at home? Oh gosh, no, very unproductive, my colleague. So again, you get that natural bias coming through in some of these surveys. So look, but a lot to understand. I guess, what we're sort of starting to see is that there's been a lot that's happened in the last, even in the last month. I mean, some elections that have been going on, there's some wage subsidies coming off, and businesses got to try to understand what they're going to do. And not all the time, but a lot of the time, they're trying to make rational decisions about culture and collaboration and productivity and how they actually build the company for the longer term rather than the short term and some of this disruption. So some of this workplace strategy that they're looking at and downsizing and reducing space and sort of, I guess, changing to be more flexible aren't really easy decisions, and so there is a little bit of a slow period for people to try and understand what's happening, and we do expect that'll take a little bit longer, and it potentially could sort of creep into even January, February before there are some real decisions being made from those larger businesses. But what we do expect is that there will be a slight reduction in that office demand that we have sort of seen occur over the last few years. But to be honest, the last few years of business growth have been exceptional anyway, so maybe moderation can be a little bit good. But there are definitely some signals there that there is a little bit more space becoming available across the Auckland market. So when we start looking at the North Shore side of things, look, the light blue there in office, you can obviously see that really started to increase. There's a couple of things there I'll just sort of point out. 2008, 2009 is when we had a whole lot of sort of development occur in Rosedale, North Harbour and the like, and it was sort of a whole lot of little pockets of space that unfortunately didn't fare so well. But of course, trying to find vacancy in those sort of spots over the last little while has been pretty difficult. So you can sort of see what's happened there. Retail, again, similar to what I was sort of mentioning, 2015, there has been that increase in the shore. But look, that industrial really has been, I guess, running for gold almost across the market, and really that is Auckland-wide. Key understandings there of essential workers and the like. So if I just sort of break that down a little bit more for you, because I know you guys all love a bit of data, especially when you're having a few beers as well. But It is not all equal, and so like I've split it out by retail, industrial and office. So dark blue for office, industrial is the gold one, and retail the light blue. The red line there represents the 10-year average of the vacancy rate, and the numbers represent. So what you can sort of see there in the office market, look, things are running relatively normal. There has been a slight increase, but we're running along that 10-year average. Industrial, things are going pretty well. Wairau-Valley's just stepped up a little bit. There was one big shed that's sort of come up and that's affected that number. This survey was done in August. That's actually been leased over a short term of about 6 months. So that vacancy is actually going to drop down to around about where that average is. So it's obviously the retail sector, and as you can see there, Takapuna's retail vacancy not just a little bit higher than its long-term average vacancy rate there of under 4%, unfortunately at 12%. And of course, for many of you that will know, in Takapuna, there's been some relatively large increases in the retail vacancy there, with the likes of the Max Bar, Portofino's, is just a couple of examples, but obviously some others through Hurstmere. The roadworks obviously has been a bit of a challenge, obviously overdue and well needed and the like, but yeah, obviously hampering what's happening there. So again, everything not equal, but if you think back also to what was happening in 2015, really across the whole sector for the retail sector, there has been some challenges that need to be taken into effect. But when we look at the industrial going pretty well, office going pretty well, just businesses trying to understand what to do from a workplace strategy perspective. So we start thinking about the demand, so we kind of understand really at the moment, look, it's been super strong, things are changing a little bit, especially in the retail side of things. The office, people will try and get their heads around it in February, March, and then industrial's going really well, and that's supported by other things like logistics and the retail delivery element. When we start thinking about building, we have a very good ability to all of a sudden gear up quite quickly in the industrial space. When we want to build some more industrial sheds, we seem to be able to do that pretty well, but we pull back pretty quickly as well. Office and retail, obviously much more complex, costs a lot more money, all those things, and so from that side of it, we don't necessarily always build enough, which is why you get this depressed vacancy rate sort of situation, whereby if you're an occupier and you're trying to find that perfect space, it can be difficult, especially because basically everyone else is trying to find that same spot as well. So look, we're probably at the moment, that non-residential demand is strong, but the supply side of it really isn't going to kick up. And so what you're going to have is probably, and as sort of Tony mentioned, you've got this increase that's probably lurking around the corner with constraints. People are starting to hire again. You've got this potential whereby you're going to see that demand and supply start to get that imbalance again. Potentially not like the residential sector, but still some strong growth potential coming through. One thing I just sort of talk about on the residential side is apartments. So we track all apartments across Auckland. So you can kind of see a development cycle very well in the apartment market. 2010, 11 and 12, no one in Auckland built apartments. There just wasn't the appetite for it. We all thought things weren't going to go well, but slowly and surely we've started to build that up. So yellow represents how much apartment by the number of units are actually currently under construction at the moment. The forecast of the year represents when it's actually going to, or expected to be completed. Sometimes they get deferred a little bit and move into the next year, so that gives you a little bit of a nicer sort of growth profile. But currently at the moment, with the marketing and consent for apartments at the moment, we're pretty close to getting into one of the biggest apartment builds that we've sort of seen in the last couple of decades. So that will be an interesting one. I guess what we're sort of starting to notice is quite a shift in what apartments represent for Aucklanders, because in the light blue represents suburban apartments. So typically our apartment stock in Auckland, around about 60% of that has been in the CBD, but of course as prices keep on increasing, the value of land keeps on increasing, so on and so forth, the unitary plan, you do get this increase in development intensity. And so what we are seeing really is a significant shift of the number of apartments being built in in the suburban market, obviously a little bit cheaper, better infrastructure is supporting it as well. So something that will be a really interesting thing to watch over the next couple of years, because when you start thinking about some of the Kiwi build projects, they're actually helping some of the suburban apartment developments actually work. It does provide some development funding. So just watch over the next little while. We do expect that suburban apartment market will just start to creep up higher and higher. Some of those ones that you thought were 600, 700 might be. Yep. Yeah. Yeah, so CBD is basically your around the motorway ring, and then City Fringe will sort of head out more down towards, say, Green Lane, Mount Albert and the like, and then work your way through Ponsonby, Parnell and that side of it. And the North Shore sits in the suburban market. Yep. So look, it's pretty interesting from residential apartment side of things. So look, I guess just sort of stepping back quickly into what we're sort of starting to see. So we've got the supply and the demand side of things occurring in the commercial, industrial, and retail space, and we kind of know what's sort of happening there. What we've sort of seen with rental growth is pretty interesting over a longer period of time as well. So I've just indexed this to so it all sort of fits on the same chart and provides you, I guess, a relatively easy way to sort of see how rents track across the different sectors, and there isn't really a lot of difference in it. The one difference really is in the retail sector, so light grey for the CBD retail and in the red suburban. So again, unfortunately, suburban retail, so this is Ponsonby, Newmarket and Takapuna, just hasn't really had that lift in the retail rents in comparison to what the other sectors have seen over that last 10 years or so. So it's not necessarily to say that it hasn't increased, just hasn't increased as much as we've seen in the other sectors. And that's the same in the retail, in the CBD. And there's lots of functions around that in regards to products that are being able to be sold. Can you put up your prices? Probably not. We're all searching and we're all looking for those different products, and it's much easier to get it to our door. So there are those changes. What we sort of see at the moment is really a flattening of those rents. So we call it face rents or effective rents. So face rents doesn't include an incentive, the effective rent does. So this is just the face rent. And what we are sort of seeing at the moment, even though we've had those rental increases of around about 2 to 3% per annum, what we're starting to see now is those face rents just hold, but we are starting to see some interesting increases in incentives. In the office, in the metropolitan office market, you're looking at the moment around about 13 to sort of 15% per month per year of lease term. So 13% per year of lease term, which equates to just under 2 months per year of lease term. So we've sort of shifted up from around about 8% or 1 month per year of lease term. So it has been quite interesting to watch that, and that's where those effective rates are starting to come back a little bit. So yeah, some interesting times ahead from a rental perspective, but just watch where those rents will start increasing again, going back down to, I guess, some of the fundamentals that Tony was talking about. And also one thing is very interesting. Typically, rents always increase by around about 2 to 3% because that's what's put in a lease agreement. And it's just one of those things that's been around for a long period of time. Have a look at that, maybe have a chat about that with your landlord. That'll be quite exciting for our guys, all smiling on the table. But yeah, it is an opportunity. Because it's just been one of those things that's been so standard for a long period of time. It is an interesting element to consider. So look, when we also think about, I guess, the buildings on top, it's the land underneath, and that's the stuff they're not making any more of, and all those sorts of things. But what's really, really interesting for us, and probably one of the different shifts from, say, this time to the last downturn we had, even though it was quite different from the GFC side of things, was just how industrial land prices and residential land prices as well have gone bananas. Look, these residential developers that are very keen to get their hands on large plots of land, for apartment developments, because that suburban has become very popular. Look, that industrial, still very low vacancy rates. There is probably opportunity to start, developing industrial space, and so that has become very, very popular. We didn't expect that to happen. We thought that would actually start to slow down a little bit. We didn't expect that would be so much activity, but From my side, from the research side of it, it's actually pretty hard to keep up at the moment with the industrial land prices. Typically we wait for an outlier, then we wait for another outlier, and then it's an outlier, but at the moment I've got lots of outliers which sort of indicate to me that it's probably not an outlier anymore. We're starting to get some more sales evidence coming through with land values, industrial land values at around the $1,000 mark now. So and that really does provide some interesting opportunities really for people looking to buy property now, because if land values are going up so much now, it's probably going to have that roll-on impact on what prices will be. This sort of breaks it down by different locations. Given the difference, I guess, here in the North Shore with its different zoning, you can kind of mix it up a little bit. So there is quite some fantastic prices already being achieved in the North Shore. From all the indications that we're getting, if you can get any kind of land in the North Shore, it's pretty sought after, and there'll be lots of competition for it.
Chris, is this similar to around New Zealand as well? Similar property?
Yeah, very much so. So I was actually on a call with our guys this morning from Queenstown, Tauranga, Hawke's Bay and the like. Yes, definitely. Residential, industrial is going gangbusters all throughout. Queenstown, which had a bit of a blip for sort of April and May, for obvious reasons, is going really well again, and so that sort of seems to be the trend that we're hearing across the country. And again, you can kind of understand in some respects, because if this was supposed to be the worst time in the market, this is when you're supposed to be buying land as a developer, right? And also because interest rates are so low, the opportunity cost of putting it somewhere else means that you're basically, this is the perfect storm for actually buying land. The problem is everyone's had the same, and it's cheap money, and everyone's sort of going into it. Which sort of brings me into, I guess, the investment side of things a little bit more. So we track all commercial, industrial, retail sales across the country. So this is just for Auckland. We break it down into different property types. Kiwis love industrial property. In some respects it does make sense, because you get investors, but you also get owner-occupiers. Owner-occupiers in the industrial sector make up a significant amount of our workforce, and so typically on an annual basis, depending on the total volume that you have, around about 50% of all commercial activity or sales activity will be in the industrial sector. That's good for a couple of reasons, of course, because if you're buying into it, it probably means there's someone else there that will buy it if you want to sell it. What we can see also through here is, obviously we haven't necessarily had as many sales occurring recently. You can see there was a sort of a natural cyclical peak there in 2015. What's actually happened is that people thought, interest rates might start increasing, so look, we'll sell off some property. We've made some good gains here, and the like. Of course, that doesn't happen because inflation never goes up. Interest rates stay low, and they keep on getting lower. And now people are going, okay, what am I actually going to do with my property? I'm going to hold on to it. I'm going to actually get some of that more capital appreciation, which has been going on pretty well for me recently. So I'm going to hold on to that stock. So what we've actually seen is a decrease in the amount of stock being sold in the commercial and industrial market, which ultimately means those prices, and it's a key catalyst to why those prices have been increasing so much. So you definitely, unfortunately, at the moment in the commercial, industrial and retail, in some respects as well, you're just getting that fear of missing out element that's rife in the residential sector at the moment as well. And so now you're starting to really get some very high prices and low yields, and a lot of people sort of expecting that these interest rates are not going to be increasing in the short time future. Of course, industrial and commercial and retail and the like should be a long-term game. Doesn't necessarily always work out that way, but it definitely is at the moment one that people are really flocking to. But they're still looking at those underlying fundamentals again. When we go back to that slide on the economy and all the variations occurring, people are still looking at those fundamentals to make sure that they are investing in the right sector. So when we look at North Shore, this is just North Shore, and we break it down. Of course, there wasn't necessarily a significant amount of stock to sell in the late 80s. It sort of gained a bit more momentum. Very similar trends to what's happened really across Auckland and across New Zealand as well. I should just highlight 2020 is provisional. There's massive amounts of data lags, a lot of data lags this year for us in the commercial and industrial sector as well, unfortunately. But look, similar sort of outcome around about. So yeah, in the North Shore it represents around about, on an annual basis, around about 10 to 15% of all of Auckland's sales. So there's quite a lot of turnover in the North Shore. That's because there's a lot of stock, so you've got a lot of smaller units actually facilitating the market. But again, it does sort of represent into that industrial sector, but also some of the office and the retail side as well. Again, it's really, and you know, we're talking with the guys, auctions very popular at the moment. Even, you know, off-market transactions are very popular at the moment as well. You've probably, you know, if you're in that space, you didn't even realise something was being sold, and it's already being sold, and there's a lot of activity going on behind the scenes as well. So, yeah, unfortunately, very, very hot market at the moment. Just to sort of wrap up with the last couple of slides. So the light grey line there might be a bit hard to see, but that's the 10-year government bond, is just to sort of give you a proxy, I guess, of if you'd like to put some sort of base rate. You can put whatever your risk margin is on top, or whatever margin your bank provides you, versus what's happening across all the different yields across the commercial, industrial, retail space. Of course, we all should have been buying commercial property back in 1995 if you get access to the money, and you know, there was a little bit of a blip, but it's getting, it's compressing and just really getting firmer and firmer. So, I mean, when you start looking, industrial is probably one of the most sought after. It's one of those ones that's got the, I guess, a lot of defensive characteristics that people like at the moment, so that's why people are chasing it. We're starting to get really reports now of industrial property trading in Auckland at around that 4% mark, to sort of 4.2. A few months ago now, there was a place in Tauranga that was 3.99%. It was around about $10 million. And yeah, we're sort of really getting that all going through the other sectors as well. From a retail side of it is a little bit different. Obviously, the different sectors, you've got your strip retail, supermarkets, very hot. Bunnings and the DIYs and Mitre 10, you know, all that sector are very hot as well. That pseudo-industrial actually takes up a lot of land as well. And you know, we're starting to get reports of those yields transacting at 4%. There's some that are sort of being talked about in the high threes. There's a little bit of funny stuff going on in there in regards to the way that some of that money is being shifted around. But yeah, so that's basically where you thought it was sort of fives, it's now fours, and we're almost starting to get to that point where the yields could sort of start to move into the high threes, which is, yeah, pretty amazing. Retail, yeah, very different, and it will really depend on where you are and what you're investing in. Office is also going very strong, so large CBD sort of offices in Christchurch, they are now sort of in the mid-fives. I would have said like 12 months ago, 18 months ago, they would have been in the mid-sixes. We're hearing reports of a large office transaction in Wellington that's 4.5, where last week they would have been at sort of 5.5. So again, interesting times for a researcher, but yeah, there is just so much pressure that's coming on to the market at the moment. So yeah, it's a kind of a very strange market at the moment. So when we start, you know, from an investment side of things, everyone really is looking at the moment past these short-term fundamentals and looking at how the performance of commercial property is done over a longer period of time. They do expect that what's happening in the fundamentals from a demand perspective and a supply perspective is really only going to be a short-term phenomenon, and they are really looking for that long-term opportunity and where they're going to secure hopefully some yield and rental and return growth. So look, just to wrap it up from me, four key points, because Tony can remember 3 hours, I can only remember 4 points, right? So yeah, I guess it's been pretty interesting. We have probably been pretty lucky to be supported by the Reserve Bank and the government in some respects from a commercial market perspective in those asset prices. The North Shore is pretty similar to what happens across the Auckland market, but there are differences. There are some I guess little unique characteristics about what happens in the North Shore market, just given the bridge and also how it does service the North Shore, but an expanding population moving out to the west as well. Not all fundamentals are fundamental at the moment. Typically I sort of suggest, always search for the fundamentals, but at the moment we do have a little bit of a juxtaposition whereby we've got investors who are very hot in the market and occupiers who are not necessarily as sure. We probably, again, that February-March period will probably solidify it and help people out a little bit more in regards to where things will be going. But try and look for and search for those fundamentals, but don't be surprised if you're trying to purchase a property or trying to lease property and someone else isn't actually thinking of those fundamentals. Look, low interest rates, I think, it's the key topic really for our sector at the moment. When you've got that low interest rate, it really is driving what's happening in the market. So it's probably going to be carrying on for a little while. There's not too many indications that it will start increasing. So if you think a 4% yield is high at the moment or low at the moment, depending on which way you look at it, it's probably going to be changing, unfortunately, in the next 3 to 6 months. So just like that slide that showed where yields were in 1995 and you wish you'd bought, potentially you're going to be saying the same in 2020. So thanks everyone for your time. If anyone's got any questions on.
A lot of office tenancies on the North Shore took a bit of a hit during COVID. A lot of people were having lease expiries and moving out working from home. Do you think the vacancy gap on the North Shore kind of around constellation for how long do you think it'll take to fill?
So what we're sort of suggesting at the moment is a 2020, end of 2021, early 2022 period is where we expect that unemployment and basically also where that will filter through into the office sector. And so that's kind of our peak of where we think the office sector will start to really reach its peak in its vacancy rate. The great news is, and shown on that economic slide, is that's our best guess at the moment, and that's based on a whole lot of factors and forecasts that are coming out, but they are changing rapidly. We're getting more positive stories come out on a regular basis. So look, that could really be, I would suggest probably has a more positive expectation than a negative expectation of that vacancy rate. So where we're sort of suggesting that vacancies will start to increase and head towards those long-term vacancy rates for a longer period of time, there is a lot of potential that it won't actually happen for that longer time. So that's where we're sort of suggesting it was. Fantastic. I'll be hanging around as well. I'll happy to answer any questions. Thanks very much.